This is the Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Japanese stocks are set to open higher after Wall Street's tech rally resumes, with Nvidia regaining some of the billions in value lost during a three-day rout. Also ahead, Australia's inflation seen ticking higher in May, potentially adding to speculation that an RBA rate hike may be on the table next month. And Japan's Takeda Pharmaceutical talks about new drugs in the pipeline and the potential of AI. We hear exclusively this hour from the CEO, Christoph Weber.
Take a look at the setup across Asia because we continue to watch the Japanese yen. Of course, we have seen that weakness, and we have seen perhaps a little bit of strength in the overnight session, that given that we saw that dollar selling regularly by companies around quarter end, which is another reason why we saw a little bit of a boost on the Korean won for the first time in 8 sessions. When it comes to Australian markets, of course, we'll be watching the CPI numbers, given the more hawkish tone that we heard from the RBA last week. In the meantime, the summer Davos continues in Dalian, and we heard from Premier Lee Chang really talking about the consequences if there's a fallout in economies parting ways. But the setup seems to be a little bit mixed at the moment, but we'll see if we continue to get that positive sentiment coming from Wall Street. Take a look at U.S. futures because the S&P 500 again rebounded, and we had some idiosyncratic stories like FedEx, for example, jumping on a bullish forecast. But of course, it was again the Magnificent Seven, really centered around Nvidia after the stock entered correction territory. In fact, we heard from Steve Eisman, famous for his big short bet against subprime mortgages, sounding a little bit more optimistic about the company.
I mean, if you look at the chart on Nvidia, you can barely see the correction. So, I mean, you know, on a percentage basis, it's down something like 10%, but you have to like peer really, really carefully at the chart to see that move. So I don't think it means anything. The people who own that stock know it's expensive, but they're buying into a story. And as long as the story is intact, like Nvidia is obviously intact, the story is going to continue.
And of course, at the same time, while we're watching the sort of relentless resumption of the Nvidia story and the AI and chip story, we're still firmly watching the Fed, right? This comes at a time, Shery, that we've got bond markets really pricing in an aggressive amount of easing by March. In fact, the latest pricing, when you take a look at bond traders, looking at 300 basis points of Fed cuts by March. When it comes to the Fed itself and some of the Fed speak that we're listening to, Lisa Cook is one that is really in focus, saying that the rate cut is needed at some point, but the timing is unclear. So really kind of lifting the bar for what would the Fed need to see before they start easing. Take a listen.
With significant progress on inflation and the labor market cooling gradually, at some point it will be appropriate to reduce the level of policy restriction to maintain a healthy balance in the economy. The timing of any such adjustment will depend on how economic data evolve and what they imply for the economic outlook and balance of risks.
Let's get some more market insights with Skyler Weinand, who's the CIO at Regan Capital. Skyler, great to have you with us. And so, you know, the Fed's messaging has been pretty consistent so far, right? They want to see more convincing evidence of the sustainable return to 2% inflation. Lisa Cook also mentioned that they do expect inflation to slow more sharply next year. Do you think when you take a look at what rates markets are pricing in right now, that 300 basis points of cuts by March is realistic?
No, there are some folks that are putting that trade on, but if you look at the curve for the next 2.5 years or so, it's about 8 Fed cuts that are priced in. About 3 over the next 6 months, and then another 4 in the subsequent, call it year or so. So September is definitely on the table. December is on the table after that. And then it really becomes dependent on data. But yeah, we need another couple prints. We need 2 more prints at least on the jobs front and the inflation front for the Fed to open the floodgates, so to speak, in September. And then we could see multiple cuts between September and the end of next year. That's for sure.
For equity investors, is there any reason to veer away from the narrative of American exceptionalism?
I don't think so. Consumer balance sheets are extremely strong. Corporate balance sheets are extremely strong. debt level, the interest expense for U.S. corporations is actually lower today than it was a couple of years ago, even with rates as high as they are, because corporations are smart and they locked in low interest rates post-COVID. They refinanced, they took out a ton of debt, and their interest expense right now is as low as it's been in a couple of years. So corporates are in an extremely good position. That includes high yield. Leverage levels are low. And then if you look at U.S. consumers, U.S. wealth has grown $40+ trillion since 2020, from 111 trillion to about 151 trillion today.
And all of that money will get spent at some point, right? I mean, there's so much sitting on the sidelines at a time when we're headed towards a presidential election. And we know that no matter who wins in that presidential election, we will see more spending. Is that a cause for concern, given that we're expecting inflation to fall? How will inflation fall if we continue spending?
If growth wasn't there, that spending would definitely be a concern. But you have housing that's grown 13 to 15 trillion in the last 4 years. The U.S. stock market alone, the total market cap's up $11 trillion since November 1st. So when you compare U.S. government spending, deficit spending of maybe $2 trillion, you have credit card debt at $1.5 trillion, you have student loan debt at about $1.5 trillion. All that really pales in comparison to the amount of equity that's built up, whether that's in housing or whether that's in equities. Folks that have this money sitting there that could be tapped if and when they need to spend it. Now, the economy is very bifurcated, so asset owners have done extremely well. The folks that aren't asset owners, that don't own homes and don't own equities, they're in trouble. And so the Fed is paying very close attention to those folks, to Main Street, to bring inflation down. They aren't even thinking about raising rates until they see inflation, I think, hit right around 2%.
You sound like you have very strong conviction when it comes to the U.S. market and also a soft landing for the economy. Are there any other markets out there that give you such high conviction as well?
We see the yen at 160. I had to squint, and go back to 1990, 34 years ago when the yen was at 160. Okay, so Japan's doing okay, absent the high levels on the yen. But generally speaking, inflation's coming down in Japan. What they're doing there is working, okay? We look at pockets like Australia, especially India and Pakistan, developing countries where, whether it's cheaper labor or cheaper places to do business, are doing extremely well. So looking at Asia, it's very country and region specific. You can't include China with Japan, obviously. So Japan looks good, India, Pakistan, Australia, okay. Europe's actually coming back. Some of the signs in Europe are showing that they're showing signs of life. Inflation is abating. What they've done thus far is worked in order to slightly turn the economy around. But yeah, the real growth engine is going to be, the AI revolution, which is, primarily in the U.S., but a tad bit in Southeast Asia.
A couple of sort of honing in on what you've just said. What do you like in Australia, and what would it take for you to change your conviction against China?
Speaking to China first, we need to see the property boom there. We really need to see that kind of play itself out. There was a tremendous amount of cash in debt built up in building, property. I think we're maybe only in the second quarter out of 4 of seeing that really play itself out. And then, we have onshoring, we have the Russia-Ukraine conflict, where we really don't know what side China is going to come out on. And that could take 5 years for it to really, really shine through. As it pertains to Australia, you talked about them thinking about, cutting at their next meeting. And so they're showing some green shoots there relative to the U.S. where, hey, look, we may need to really tamp down inflation in order to bring the economy into, control, so to speak. So, I would be looking at outliers, like a Pakistan or like an India that have done extremely well this year, to make a bet, so to speak. But if I'm a retiree, I'm probably placing my money in a Japan or in Australia if I'm in Asia.
I see. What about the tech story? Because we continue to see this rally in the Magnificent Seven, but you mentioned some of those geopolitical risks out there. We're now hearing that OpenAI is taking additional steps to curb China's access to artificial intelligence software. I wonder if all this bifurcation and divergence and just clashes when it comes to tech hardware, semiconductors, now artificial intelligence software, how is that going to impact the sector long term for an investor?
Well, there's a tremendous amount of R&D spending that is going into AI. We see Meta, Facebook, that have turned from the Meta universe. Maybe they'll rename themselves AI Book from Meta because they've switched away from the entire concentration on Metaverse to, hey, we're going to spend this money on AI, and Meta's done extremely well since then. So, focus on the hardware for right now, but we're only 2 to 3 years away, I think, before the software aspect, this Microsoft versus Meta versus Google, where that really comes to fruition and it starts replacing jobs, okay? And so that we'll see this huge catalyst, I think, on the software side, whereas right now it's primarily on the hardware side.
Skyler Weinand, good to have you with us, CIO at Regan Capital, with his market calls, and a reminder of our big guests coming up on the Asia Trade. Stick around for conversations with the CEOs of Takeda Pharma, EFG, Suntory Beverage and Food, and Advantest. This is Bloomberg.
Australia's May CPI due out in a few hours' time, and economists that we've spoken to see inflation climbing year on year, and that's of course adding to speculation about a potential RBA rate hike in August. Our economics reporter Eswar joins us now. So how key is this data in terms of putting that further tightening back on the table?
Yes, sir. This is a monthly inflation report. It does not cover everything, so it's roughly 50% of the basket. It's not as important as the quarterly report, which will come out next month, but it is a very good indication of where prices are heading, and it looks like prices are heading in the wrong direction. So economists' estimate is for 3.8%. That is higher than 3.6% the previous month, that was April, and it is something that is already worrying the central bank because our interest rates are not as high as the US or New Zealand, and there are questions about whether policy is restrictive enough in Australia.
We keep looking at indicators that are holding up, mixed to Brazilian, right? But if you talk to kind of Main Street households, anecdotally, people are struggling. How much more pain, I guess, can the broader economy take in terms of more tightening?
The economy is definitely slowing down, and we are seeing that largely in households. As you said, people have cut back on spending drastically. There's a lot of essential spending happening, but there's been a pullback in discretionary spending, and that has affected our economic growth. But the labor market is still tight. Unemployment is still hovering around that 4% level, which is low. And that is giving the RBA some confidence that if they need to, they can raise interest rates without causing recession. And I also think next week we have tax cuts coming into effect. We have the government's energy rebates coming into effect. So that is definitely going to boost consumer sentiment to some extent. It's pretty downbeat at the moment, but these two factors will definitely provide some support. So in that scenario, the RBA should be a little more comfortable to raise interest rates if they do need to.
What are the implications of a rate hike for the broader economy? We know that decision is coming in August, but given how the housing market has reacted so far, given how lenders have worked around the interest rates by the RBA, where are we going to see the biggest impact if, in fact, we see that rate hike?
Yes, right now, the biggest impact is being felt by households. Businesses are still resilient. So I think when we have another rate hike, if we do get one, households, especially those with mortgage, are going to be very further impacted, more deeply impacted. Businesses have proven to be more resilient. We are seeing some signs of pressure or pain points in some sectors like hospitality and construction. Another 25 basis point increase may not affect businesses by a lot, but it's really the household sector where the greatest uncertainty is. We also don't know, with the tax cuts and the government's energy rebates coming next week, we also don't know whether consumers will save it, whether they will spend it. What happens in the second half of the year is still pretty uncertain. So the problem right now is that inflation is still not under control. In fact, prices are moving in the opposite direction, which is a worry for the Reserve Bank. So if they do have to, they have been talking tough on inflation, so if they do need to, they will probably go for that 25 basis point increase.
Our economics reporter Swati Pandey there with the latest on the Australian economy and really trying to tamp down inflation, and a completely different problem that China has, of course, are deflationary pressures at the moment. Economists, though, have upgraded their forecast for the country's full-year growth to 5% on the back of strong exports, even as consumer spending slows. China correspondent Min Lo is in Hong Kong with details of our new Economist survey. And Min, it's been really a patchy recovery, right? I talked about those deflationary pressures, given that consumption seems to be pretty stagnant at the moment. What is the overall picture like for the Chinese economy for 2024?
You're absolutely right. Right now, the outlook has improved by a little bit, and that's really buoyed by exports. And this is driven by a global shift in demand from services back to goods as other economies continue to recover. And we've also seen Chinese exports beating expectations in both April and May, and this reflects the growing competitiveness of Chinese exports. But of course, exports is still the area where we see increasing headwinds with all these accusations of overcapacity and leading to more and more trade barriers targeted at Chinese companies. But if you look at that growth forecast there, the table on your screens now, retail sales expected to grow at 4.9%, down from 5.2%. And also economists paring back expectations for consumer price inflation as well as factory gate inflation. This really reflects that pessimism in the economy. Consumers still holding back spending as the property crisis continue to deepen, as people continue to be worried about income growth and their job security as well.
What can the government realistically do at this point to boost spending, investment, confidence?
Yes, well, look, the forecast now is for a growth of 5%, and that's also in line with the government target for the year. And you heard Premier Li Qiang saying yesterday at the World Economic Forum that China is very confident of hitting that target. So if everything goes on track, we don't expect the government to really pull out any big guns to overstimulate the economy at this point. When it comes to monetary policy, we've seen the PBOC being quite reluctant to cut rates so far to protect the yuan. Economists still still hold expectations that the MLF and the loan prime rates could be cut in the third quarter. They are pushing back expectations for the reserve requirement ratio cut from the second to the third quarter as we see the PBOC shift its priority to really increase efficiency of funds rather than continue expanding its balance sheet. As for fiscal policy, we want to look out for the July plenum that could be taking place anytime in the next few weeks, whether there would be policy reforms, especially to address youth unemployment, because again, youth are some of the biggest spenders in the economy. They're the ones willing to go to the cinemas, to the concerts, and then also whether there would be policy reforms when it comes to boosting confidence in the private sector.
It's an uphill battle. Our China correspondent Min Lo there with the latest. We do have much more ahead on the Asia trade. This is Bloomberg. Well, OpenAI has reportedly warned Chinese developers it will begin blocking their access to their tools and software from July. That suggests that the ChatGPT creator is taking a more active stance to bar users from nations where it doesn't offer services. Let's bring our tech reporter Annabelle Jewellers in Hong Kong. So, Belle, what more do we know?
Yeah, well, Chinese developers going to have their access cut off in just a few days, as you say. Just to give a bit of context here as well, for people that are perhaps not familiar, if we're referring to OpenAI's API, this is essentially how developers are getting access to OpenAI's tools like ChatGPT and then integrating them into their own applications or software or platforms. That's sort of the context. What's also interesting to note as well is that OpenAI is actually officially unavailable in China, even though we know a lot of developers have been continuing to access it through tools like VPNs or virtual private networks. This story actually originated in local media first. So you had the likes of the Securities Times, for instance, picking up these screenshots on social media saying that, as you said, China developers will have their access cut off. Then it was confirmed later in the day by OpenAI in a statement to us where they said they would take additional steps to block API traffic from regions where it doesn't support access to its services. What exactly prompted the move, we really don't quite understand that as yet, but we do know that just as recently as a few weeks ago, OpenAI was shutting down operations in places like China, influence operations, because it said that it was using its tools to manipulate public opinion. There's, of course, a lot of scrutiny on this, and Sam Altman himself making these pledges to pay particular attention, especially when you're in election year. But, of course, overall, this overarching theme is that pressure we see from Washington to restrict China's access to AI technology.
Exactly. Tensions have been rising between China and the West. What's been the response from Beijing so far?
Well, no response to this one, as you might expect, but there has been actually quite an interesting reaction coming through from the private sector in China, because there is very intense competition between the Chinese tech giants as to who can create the first AI tool that really rivals ChatGPT. And we've seen the likes of Baidu's ErnieBot, for instance, jockeying in that space. Where we did see the reaction yesterday came from local players like Alibaba, Jipu AI, that's backed by Tencent, and they actually came out with notices and said, hey, you know what? If you're a developer, you don't have access to OpenAI, switch to their own products instead. So it's that sort of enticement that came through from the private sector. Shery.
Annabelle Jewellers there joining us from Hong Kong with the latest on OpenAI and, of course, those tensions between China and Western nations. We have more ahead on the Asia trade. This is Bloomberg.
Take a look at how we're setting up when it comes to this midweek session here in Asia. Australian futures looking a little bit muted there. Sydney futures up by about 0.4% there. We are watching that monthly CPI print in particular. If that shows really further signs of heating up when it comes to price pressures, it really does potentially put the risk of further tightening for the RBA at its next meeting back on the table. We're seeing futures relative to fair value an early drop of about 0.1% there. Singapore Nikkei futures looking a little bit more optimistic. That rally in the world's biggest tech companies lifting US stocks, so we can expect to see tech chip makers as well as those AI-related names rallying in the Asian session as well. Nvidia climbing about 7% after that $430 billion rout. Shery.
And Haidi, of course, is the second day of the annual World Economic Forum in the Chinese city of Dalian. Our Chief North Asia correspondent, Stephen Engel, is at the event with our next guest. Steve.
Good morning, Shery and Haidi. Yes, Eswar Prasad, he is from Cornell University. He is a professor of trade policy there. Thank you for joining us this early morning. I guess everyone else went to the evening soiree last night. You and I are up early to talk about day 2 of the World Economic Forum Summer Davos. So we heard yesterday, obviously, from Premier Li Qiang. He talked about destructive spiral will persist if we go down this road further in decoupling. I mean, the United States likes to call this sort of supply chain resilience. Do you think Li Qiang maybe missed an opportunity to address foreign participants here and maybe assuage some of their bigger concerns about the Chinese economy?
Now, what Li Qiang did in his speech was to make the strong argument that protectionism doesn't serve anyone well, and that countries can collaborate and cooperate in terms of sharing technology in order to move towards greener economies and so on. So that rhetoric was probably well received, but what was probably not as well received was the sense that China needs to play its part in terms of absorbing the capacity it is creating, and the sense among many Western economies that China is not quite playing by the rules, subsidizing those industries that are considered new technology industries like green energy, electric vehicles and so on, which are precisely the industries that the US, for instance, is counting on for its manufacturing revival. Now, one of the elements that Li Qiang did talk about was weak consumption in China, and that I think is a real concern for the rest of the world. China is, leading its economy through a production-led recovery that is creating a lot of excess capacity here, and if that cannot be absorbed by Chinese consumption, by Chinese domestic demand, then it's going to have to be exported to the rest of the world, which is precisely where the concerns of the rest of the world come in.
And you're the professor of trade policy, and that's where the consternation comes from traditional trade partners, whether it's the European Union that's talking about 48% EV taxes, tariffs, the United States, the Biden administration already upped that to about 102%, plus another a whole new list of different products, whether it's ship-to-shore cranes, surgical gloves, syringes, and the like. So it's going down a path of protectionism, but what can China do other than sort of say, look, we are the champions of free trade. You're the ones who are doing all these measures. They're going to retaliate.
That's true. I think the rhetoric coming out of China is that everybody needs to play by the rules of the game and the multilateral order needs to be preserved. But I think there is a sense that China is not necessarily hewing to those rules when it doesn't suit it, and when it suits it, it is willing to play by those rules. And that inconsistency is what the rest of the world, I think, is very concerned about. But the reality, I think, is that the baseline has been set in terms of especially the US-China relationship, that it's probably not going to get any better in the coming months or possibly even after the election. If anything, it could get worse, and the question is how much worse and precisely in what forms.
What's it going to take to reverse the trend of FDI kind of slowing down into China? Obviously, the United States, with its king dollar, as well as its AI boom in the stock market, is attracting tremendous amounts of flow of funds, investment into the United States. It happened through the pandemic as China was sort of closed off for 3 years, but it's continued. And that king dollar persists, and the AI boom, even though it had a few days, obviously, of a pause, kicked right back into action overnight with Nvidia up another 7%.
The contrast in perceptions about the two economies' prospects is quite striking. There is a sense that China is stumbling right now, that it doesn't have clear direction in terms of its policies and the overall policy-making framework. Li Qiang did talk about the need to support consumption, to deal with the root problems of the economy, and those were good words to hear, but we didn't see much in terms of substance about what the government was going to do to support growth and deal with the root problems. On the other hand, the U.S. economy, for all its problems, does seem to be doing remarkably well, with inflation declining, with productivity growth being very strong, with the labor market being very strong. And all of this certainly is feeding into the perception that, especially in the world of currencies, the dollar, if anything, is going to remain supreme for some time to come.
One would expect if Fed policy pivots and we start seeing easing, I don't know, maybe by December, maybe September, but maybe in the first part of the next year as well. I'll ask you about what your expectations expectations are in just a second. But if you take that helium out of that rising dollar a little bit, one would assume that we're going to see some dollar weakness. That's not necessarily the case, though, is it?
So in international finance, everything, Steve, is relative. So even if the U.S. Starts cutting interest rates, the question is what happens in the rest of the world? What are the economic growth prospects? What are the interest rate prospects? In China, for instance, the economy is not doing that great, and certainly some monetary stimulus would help. And the sense that if China were to cut interest rates well ahead of the U.S., that might lead to a renminbi depreciation that could become a little difficult to control. That is probably restraining the PBOC. So if rates in different countries move in lockstep with the U.S. cutting, but other countries, including China, cutting as well, it's not obvious that is going to hurt the dollar, especially if the U.S. economy continues on the very strong growth path that it has been on for a little while now.
How do you see inflation tracking in the United States? It's remained stubbornly sticky. Do you think the Fed will move this year? Will they at least cut once?
The dynamics of inflation have certainly proven very sticky, but they're gradually moving in the right direction. The question is, when is the Fed going to declare victory? It's quite not at its 2% target yet, and the Fed has indicated that it doesn't want to declare victory prematurely. So we'll have to wait and see. I mean, at the moment, the fact that the labor market remains so incredibly strong.
For now.
For now.
But there are some storm clouds brewing, aren't there?
There have been storm clouds brewing for quite a while right now, and it is remarkable that the economy has continued to grow so well. I think the real key is going to be productivity growth dynamics, because those have looked pretty strong. Perhaps it's related to the AI boom. We don't quite know yet because the data don't necessarily fully support that conjecture. But if something is in fact going on with productivity, then everything can hang together very nicely. You can have falling inflation, decent wage growth, decent output growth, but we don't quite know yet.
With the bifurcation of high-end advanced economy with the chips, quantum computing and the like, and AI investment flowing into the United States, and maybe not nearly as much playing catch-up here in China. Do you see the AI boom continuing?
That again is hard to tell, because the AI boom certainly seems to have some legs, and it is a general purpose technology which seems to be having very significant effects in many industries. Now, this is also an easy to capture technology, so it's a little hard to keep it confined within one country, but the fundamentals of innovation are certainly much stronger in the US than they are in China right now. And it's not just about AI. I mean, China talks about technological upgrading, but the real concern here is that they still need technology transfers from the West, especially from the US. They need the chips, and in terms of fundamental innovation, the sense that the government is not as friendly towards private enterprise as it used to be is certainly limiting innovation.
Then on that front, what do you expect from the third plenum, which has been delayed by some 6 months? It's the long-term planning meeting, obviously, that's going to be held next month behind closed doors to kind of chart out the priorities. But this is the Central Committee. They're not very transparent, but obviously they can lay out their strategic priorities for the next 5 to 10 years.
This is an important juncture for China, because one of the things I've picked up in my last few trips to China over the last 12 months is a deep sense of pessimism. If you talk to students, regular people, businesses, entrepreneurs, all of them are very concerned about whether the Chinese government has a clear policy agenda, the willingness to do what it takes to deal with these root problems that Li Chang talked about. The fact that private sector sentiment, both in households and businesses, is very weak. So I think we will need to see some clear policy making coming from the government in terms of the direction it wants to take the economy, but also how it plans to get the economy there. So I think we'll be looking for a lot more in specifics than one typically expects from the plenum outcomes.
And I think further courting the global south. We'll be speaking to the Malaysian economy minister later this morning as well. They've been talking a lot about cooperating not only with the U.S. in their chip space, but also China. So that could get very interesting, wouldn't you agree?
That's true. The geopolitical realignments are certainly an issue that is being spoken about at great length in the halls here, about where these middle powers, so to speak, might end up in terms of trying to balance their relationship with the U.S., which is still seen as a very important power, both economically and geopolitically, and China, with countries like Malaysia wanting to maintain closer economic and financial ties with China, but a little cautious about getting too close to the embrace of China.
Non-alignment, I guess, is the operative word there for some of these countries like India, Indonesia, Malaysia, but benefiting from both.
it's closer alignment with both parties, which I think is a very difficult balancing act, but a lot of countries are trying it.
Eswar, Prasad, thanks so much for your time. Okay, Haidi, I'm going to send it back to you as we kick off day 2 of the summer Davos here in Dalian.
Such a great broad-ranging conversation. Eswar Prasad there with our Chief North Asia correspondent Stephen Engel at the World Economic Forum, or Summer Davos, in Dalian. We do have some lines just crossing the Bloomberg when it comes to the RBA hearing from Christopher Kent. This is the RBA's, this is senior Reserve Bank official. This is, of course, the Assistant Governor, Christopher Kent, speaking, saying that the monetary settings are restrictive, although the extent to which they've cooled demand remains up for debate. Of course, policymakers are really grappling with still elevated inflation. We'll get an indication of just how elevated a little bit later on today with the monthly inflation numbers, but they are expected to have climbed 3.7% from 3.6% in April. So potentially a bit of a lift from base effects, but still potentially enough to put that further tightening for the RBA back on the table for the next meeting. Christopher Kent saying that financial conditions are particularly restrictive for households, but less so for businesses, particularly larger businesses. And of course, we have seen that through the data and anecdotally, that it has really been households and consumers that have pulled back on discretionary spending. Larger businesses and corporates, corporate Australia have been really far less impacted, but a lot of the gig economy, for example, freelancers have really felt the pinch of these raising rate conditions. The extent to which monetary policy is restrictive is unclear. So the RBA last week, of course, holding rates at that 12-year high of 4.35%. Inflation still remaining above target. And Shery, we'll get a better idea of just how far above once we get that May monthly CPI report later.
Right, Heidi, we'll be watching out for that. And right now, we're getting an alert on the Bloomberg terminal. AFP now reporting that the WikiLeaks founder, Julian Assange, has pleaded guilty in a U.S. court. Of course, this would end a 14-year legal drama that's seen him spend time in U.K. jails, not to mention self-imposed exile in a London embassy. So AFP now reporting that the WikiLeaks founder, Assange, has pleaded guilty in a U.S. court to U.S. charges, saying that Julian Assange will fly to Canberra within hours, according to WikiLeaks. Let's now turn to the latest on North Korea, because the country has fired a suspected ballistic missile in the past few hours that South Korea's military says appears to have failed in flight. The attempted show of force comes about a week after Pyongyang struck a military pact with Russia that's alarming the U.S. and its allies. Bloomberg Originals has been investigating how Kim Jong-un's regime has managed to build a nuclear arsenal despite its economic isolation.
North Korea is one of the poorest countries in the world, and yet it's also one of just 9 nuclear powers. These are long-range ballistic missiles from North Korea, capable of striking almost any target in the world. North Korea has long used heated rhetoric against South Korea and the US, but recently it's raised the stakes.
North Korean leader Kim Jong-un rang in the new year with a rally hours after making new threats. Earlier, Kim ordered his military leaders to, quote, thoroughly annihilate the US and South Korea if provoked.
One of the things that we've seen over the past year is the relationship between Russia and North Korea really flourish, and so we're going to see that relationship deepen.
So how did a country facing crippling sanctions, where the average person earns less than $3 a day, manage to build such an expensive nuclear arsenal that may be capable of striking targets as far away as New York or Washington?
For more, you can catch the full Bloomberg Originals documentary on the terminal, Bloomberg.com, and on YouTube as well. Coming up, we'll look at how South Korea and Japan are using nuclear energy to meet their 2030 emissions reductions targets. This is Bloomberg. Now to the energy transition and the growing interest in Japan and South Korea to expand the role of nuclear power as both governments strive to meet their emissions reduction goals for 2030 and beyond. Let's get to David Kang, who leads Japan and South Korea research at Bloomberg NEF. And David, we know here in Japan there's been a lot of hesitation about nuclear power after the Fukushima nuclear disaster. And yet, nuclear was the biggest winner in Japan's first low carbon capacity auction. Are we seeing a shift now?
So Japan's low carbon capacity auction essentially provides long-term payments for clean power technologies like nuclear energy storage to stay online in the market. And the biggest winning project, as you mentioned, from this year's auction was a nuclear reactor called Shimane 3, which is currently under construction. So what this means is that Chugoku Electric Power, which owns Shimane 3, will need to ensure that the reactor begins commercial operation within 4 years from now, which is a fairly tight timeline. Otherwise, it may face penalties. Outside of nuclear, we also saw energy storage projects and coal ammonia co-firing projects, which actually has limited emission benefits, win pretty sizable contracts from this year's first low carbon capacity auction.
Japan has multiple nuclear reactors that are aiming to restart operation over the next 18 months. Do we see this as being on track?
So there are 5 nuclear reactors in Japan that have received approval to restart, and they are aiming to begin operation over the next 12 to 18 months. But given that we've already seen 2 of these reactors announce major delays, we think there is a high chance for further delays in their restart. And that could lead to increase in gas power generation in Japan to fill that gap. So assuming we see 3 to 4 months of delay from these 5 reactors, this could actually increase Japan's LNG demand by around 2% over the next 12 months.
The Korean government has also announced a new energy roadmap. What can we expect?
Korea's current President Yoon Suk-yeol is very pro-nuclear, and that's really reflected in this year's draft energy roadmap. So the government wants to increase the share of nuclear generation to 36% by 2038, which would make nuclear the largest source of power generation in the country. And to do this, the government wants to build at least 5 new reactors, including the ones that are currently under construction, and 1 small modular reactor, or SMR, during this period. But given the long lead time for nuclear projects in Korea, as well as the fierce opposition that we are seeing at the National Assembly, we think this roadmap would be quite challenging to achieve. And we think Korea could actually benefit from redirecting more of these investments towards renewable energy like solar and wind, which can be deployed much quicker to accelerate the energy transition.
Bloomberg NEF's David Kang there. Be sure to tune in to Bloomberg Radio to hear more from the day's big newsmakers. You can get in-depth analysis from the Daybreak team there. We're broadcasting live from our studio in Hong Kong. You can listen in via the app, that's Radio Plus, or BloombergRadio.com. Much more ahead. This is Bloomberg. Well, Japan's Takeda Pharmaceutical says it sees multiple growth opportunities for the drug maker, including new treatments in the pipeline and the growing use of AI. Bloomberg's Isabel Reynolds spoke exclusively with the CEO, Christoph Weber, and began asking about the potential impact of a US bill seeking to sanction some Chinese biotech firms.
Well, in our case, it won't impact us much because we have no dependency on any Chinese company. We work a little bit with some companies, but it's a very little engagement. So we won't be impacted so much. We are growing very fast in China. Our business is growing very fast, but we made sure that we have no dependency from any Chinese company in our global operation, if you like.
I also wanted to ask about your drugs pipeline, and what can you tell me about the most promising drugs that you have coming up? What we've seen is that you have high expectations for, let me see if I can pronounce this right, zasocitinib for psoriasis, and a drug also for sleep disorders.
Yes,
Can you tell me about those and perhaps any others that you're...
Yes. So we have 6 molecules in late-stage development, so what we call late-stage development, meaning that it's the last stage before filing and potentially getting approval. All 6 are very exciting for patients, but in terms of revenue potential, the 2 you mentioned have the highest revenue potential. So I'll start with TAK-861. It's a molecule to treat narcolepsy, which is indeed a sleep disorder. We are about to enter into phase 3, so we are very excited about that molecules. The second one is zasocitinib. It's TYK2 inhibitors. We are developing it first in 4 indications: psoriasis, psoriatic arthritis, ulcerative colitis, and Crohn's disease. So this is a molecule with potential to treat many indications. The goal here is that to have very good efficacy, but oral, so much more convenient to be used. So that also has a very high revenue potentials, because just these 4 indications are very large indications.
One of the themes we're looking into this year, I mean, not only at Bloomberg, but I guess around the world, is AI.
Yes.
Now, how far is AI already a part of your sort of development of new drugs, and how far do you expect it to develop in the future as one of your sort of tools?
On one side, we are at the beginning of the use of data on AI, but we are moving very fast. So this is a very big agenda for us. We see already some application in research to design molecules, for example. We see application in development to accelerate our clinical trials, to design better our clinical trials. We see application in manufacturing, quite a lot actually, where we combine image recognition and machine learning to improve our manufacturing operations. We see application in commercial as well to have a better interaction with doctors. So we are moving very, very fast. So it will completely transform the company in the next 3-5 years. Yeah.
Today we've seen the yen fall back near 160 again against the dollar. Is it a benefit for some companies? It's a pain for other companies. What is the effect on Takeda Pharmaceutical?
For us, 50% of our revenue is in the US, so the yen depreciation is a tailwind for us. But that's a short-term tailwind, because if the low yen is impacting negatively the Japanese economy, eventually healthcare financing is linked to the GDP. And so if the Japanese economy is impacted, it will be secondary impacted, because there will be less financing of healthcare. So I think in the short term it's a plus, but long term, if the economy is facing a downside scenario in Japan, it will be negative.
That was Takeda Pharmaceutical CEO Christoph Weber speaking with Bloomberg's Isabel Reynolds. The market opens are next. This is Bloomberg. This is the Asia Trade. We're counting down to Asia's major market opens, and we'll be watching if we see that positive follow-through from the Wall Street session. Heidi, we saw another rebound for the Magnificent Seven, of course, focused on Nvidia.
Yeah, you'd be happy if you're an investor sort of using that sell-off in Nvidia to add to further positioning, right? But at the same time, we're still watching central banks, of course, and Fed speak out over that, suggesting that the bar may be quite high when it comes to further ease, or more easing, I should say, that's being expected by the markets. 300 basis points being priced in by rates pricing by March, Shery.
And of course, we're watching because of all of those news, JGBs. They took a hit in the previous session, given that there's been a lot of speculation whether the BOJ will need to hike rates sooner rather than later on that weakness of the Japanese yen. Yes, we're near that 34-year low again, but at the same time, we saw perhaps a little bit of strength in the overnight session, given that there was a lot of dollar selling by companies near quarter end. We're seeing the Nikkei extend those gains from the previous 2 sessions up for a third consecutive consecutive day, and we're watching those JGBs as well, the 10-year yield above that 1% level. But as I said, it was really about the dollar selling story among companies, right? Take a look at how South Korea is coming online, because that also led to the Korean won seeing a little bit of gain against the U.S. dollar for the first time in 8 sessions. We're seeing the cost be under a little bit of pressure, down 0.25%, but of course that tech-heavy Kosdaq is higher by 0.5%. The semiconductor chips AI story is still fueling some of those tech names, Heidi.
Taking a look at how we're setting up when it comes to the staggered open that we see here in Sydney. And Shery, we're watching very closely the monthly inflation report, which is expected to tick up to 3.7%. And this is, of course, a data point that doesn't cover the full inflation basket. But certainly if we see that acceleration compounding, of course, some of the other indicators that we've seen, potentially that does put the risk of further tightening for the RBA back on the table for their next meeting. We did get, of course, really some commentary when it comes to Assistant Governor Christopher Kent speaking earlier, saying that rates are not restricting very much when it comes to larger firms, but playing out much more when it comes to Australian households. So that is really that balancing act that the RBA is looking at the moment ahead of the inflation numbers. This is a picture, as we see, a little bit of downside there, risk aversion for the start of the equity session. The Aussie dollar is holding pretty steady. It's been kind of pretty range bound around that 66 handle so far this week. And switching out to take a look at commodities as well, Brent in particular. This is a picture when it comes to trading for oil prices at the minute, as we see those declines largely being held. We had one industry report pointing to some gains across stockpiles, Shery.
And Heidi, Treasury is really barely budging. 10-year yields really staying unchanged at around that 420 level. Of course, we're really digesting a lot of Fed speak, and not to mention just expectations of where rates go from here, given that U.S. consumer confidence continued to weaken according to the latest data. Let's get more with our executive editor for Asia Markets, Paul Dobson. Paul, so how are markets right now taking in all of this Fed speak, not to mention expectations of when we could finally see a cut?
Yeah, good morning, Shery. So the market seems to have come around to the view that we'll be looking for a couple of cuts by the end of the year. So a little bit more priced in than what the Fed said to us in its latest dot plots. And that is based on this idea that the data is starting to show a slowdown. So people are watching the consumer, I think, quite carefully. So those measures of confidence, but also the measures of spending. If that continues to come down, then maybe that puts a little bit more pressure on the Fed to act a little bit sooner in terms of moving to reassure the market and the economy. I think kind of what's been interesting is we have seen as well the labour market starting finally to show a little bit of weakness, and then the inflation numbers as well going to be in focus when we get to the end of the week, particularly with the PCE figures. I think looking across the corporate sector, there have been some signs of that consumer weakness showing up as well. For example, we had the earnings from a company that called Pool Inc., which makes swimming pools, saying that consumer discretionary spending on that hasn't been as strong as it would have expected, had a big dip in trading as a result. And on the flip side of that, you know, some of the big retailers, the Walmarts and the likes of that have been showing some equity strength. So people, you know, kind of looking a little bit more at managing their household budgets. So that tells you a little bit about the idea that the economy is slowing, which, you know, not dramatically at this point, but in a nice sort of glide path that could lend that soft landing narrative a little bit more traction and push us towards the idea of Fed cuts later in the year.
Yeah, and the sort of view on what those cuts look like is pretty wild, right? If you take a look at this chart for market pricing, we're looking at almost 40 basis points priced in for 2024, another 20 by March 2025. But rates options markets, we're seeing this wager that has a bold bet on 300 basis points of cuts by March.
Yeah, so it looks like it's some interesting hedging going on there in the options space. Either people are pricing in the risk of some rapid slowdown that would force the Fed to act much more aggressively, or finding some ways to hedge their portfolio in a relatively cheap manner. But as a result, you know, there are these trades going on underneath the surface of the market that are looking for a really big slam on the brakes by the Fed. And it's not impossible that, you know, there could be some big surprise or shock that could trigger that kind of thing, but it's pretty big big outlier trade at the moment. So, interesting to keep note of and to watch what other people are doing and what's getting priced in, but probably not the consensus view that anything like that is in the cards anytime soon. Let's hope not anyway. Otherwise, it'll be a wild second half of the year.
Our executive editor for Asia Markets, Paul Dobson there. Let's take a look at how this rate environment is really playing into banking. Giorgio Pradelli is the CEO of EFG International. They offer private banking and asset management services. And he joins us now from Singapore. Giorgio, great to have you with us. And it's a great deal of uncertainty when it comes to banks and financial services at the moment, right? Are you feeling that across your business?
Good morning, and thank you for having me. So yeah, we see a lot of business at the moment. I think it's a good market environment for a private bank. I think we're navigating well. Interest rates are high, which for a bank is not bad. Markets are doing well. Performance are good. The economy is resilient. So overall, we see a good environment.
What about your business in Asia?
Our business in Asia actually is doing extremely well. For us, Asia is a strategic region. It's actually the second largest. The largest region is Switzerland and Italy, but Asia Pacific is the second largest with over 30 billion. But at the moment is growing very, very fast, both in Australia and in Singapore and Hong Kong. Last year we had double-digit growth rates, about 12%. In terms of NNA, and this compares to our target range of 4 to 6. So basically double the top end of the curve. So we're very pleased with our business. And to close, we have been investing very much in the region, in all the locations that where we are in.
Tell us a little bit about the Swiss business in particular, given that we saw the second consecutive rate cut by the SNB last week.
No, I think we are in an environment where I believe rates will come down. I was following the previous commentator talking about the Fed. Obviously, there is a big debate, but Switzerland, in terms of wealth management and private banking, is probably one of the strongest financial centers worldwide, and the overall ecosystem of private banking wealth management is doing very well. We are doing very well. We are growing, but clearly, in Europe at the moment, wealth creation is not at the same rate as in Asia. But otherwise, we are very pleased with both businesses.
You talked about investments earlier, and of course, we have seen the reports of a potential merger between you and Julius Baer. What can you tell us about your thinking in regards to a deal that could look like this? I know that you potentially can't really talk specifically about Julius Baer, but what would a concept like this entail for you?
Well, I think there have been a lot of speculations, I think, since it was, I believe, at the end of May. And again, we don't comment on market speculations. Actually, we like to respond with facts. A few days later, on the 28th of May, we came out with our trading update for the first 4 months of the year, which was very good. Our growth is over 7% globally, which is the highest in the last 15 years, and our profitability is very strong, in excess of 110 million net profit for the first 4 months, which indicates a double-digit profit growth for this year. Regarding consolidation, I think there is a lot of talk about consolidation in our industry, but at the end, at the moment, the M&A landscape is relatively dry. We saw obviously last year big consolidation, which was more forced. For us, we like acquisitions. And actually, the last acquisitions we have done, the last important acquisition we have done was 5 years ago in Australia. We acquired Shaw and Partners, which has been a great investment, a great partnership, and we are extremely happy. About other possible speculation, we have so many things to do. We try to focus on what we have to do more than speculate about scenarios that might not happen.
But it sounds like the appetite for M&A growth is still a focus, right? Can you kind of give us some insight into what you would be looking for, hypothetically, if you will, and if there are any sort of deals and possibilities and different types of structures that are in the pipeline that might be compelling for the business?
Yeah, no. Well, first of all, we are in the middle of our strategic cycle, 2023-2025. We are exactly, in the middle. When we announced our strategic cycle for 2025, we said that obviously the focus is organic growth. On the other hand, we like M&A. We like the ability to grow inorganically. And we have three criteria, which are very simple. We like to focus on the locations where we're already present in order to generate synergies. We like to have a cultural fit. We have a very specific client-centric business model, so it has to fit. And the third is obviously, the acquisition has to be accretive, and we have a return on investment over 3 years of 10%. So if we can find a combination with these criteria, we like to look at opportunities. But as I was saying, the last 5 years, the last one was Shaw & Partners, great investment. We're very proud. But since then, we didn't find a lot of opportunities. We will see. We'll see now in the next chapter, in the next second half of our strategic plan.
Well, you're in Singapore. Are there any good fits across Asia?
Well, we like Asia. We would love actually to strengthen our presence in Hong Kong and Singapore. As I said, in the last 5 years, we had a couple of opportunities that we looked at, but we didn't manage to close. As I said, at the moment, there is not, I would say, a wave of opportunities, but we are very, very focused on looking into and screening the market. But nothing at the horizon concretely, I'm afraid.
George Pradelli, CEO at EFG, great to have you with us. Do join us again when you have something more concrete across Asia, where, of course, he's seeing those opportunities. We have more ahead on the Asia trade. This is Bloomberg. Take a look at how Japanese assets are trading early in the session. We're seeing the Nikkei up 0.2%, being led higher by tech and communication services stocks. Although real estate and energy stocks are down at the moment, and you can see the Topix is down 0.2%. The Japanese yen really holding steady in that narrow trading range. Of course, we're still waiting for any confirmation from the BOJ on more hikes to come. It's a little bit stronger in the overnight session, given that we saw that regular dollar selling by companies, and JGB is really not doing much. But one stock that we're following in today's session, Suntory Beverage and Food, because this stock has gained about 27% year to date. Of course, we're talking about gains in a very inflationary environment across Japan. We are expecting Tokyo core inflation to have strengthened again past that 2% level year on year when we get data on Friday. Let's discuss broader consumer trends with Makiko Ono, President and CEO of Suntory Beverage and Foods. Makiko, it's really great to have you with us today.
Thank you for having me
Let's
today.
discuss a little bit about what you're seeing among consumers, because we're talking about consumer trends having changed not only before COVID, post-COVID, but also here in Japan before inflation, after inflation.
Yes, really something happening. And for the manufacturers like us, we did the price hike in the past 2-3 years. To react to raw material and packaging cost hikes and also energy cost increase. And then we have just seen the shift from national brands to private brands, but not a major part, but in some part, the real Japanese consumers, they are shifting to private brands. But that is one part. And of course, as a national brands company like us, we think we need to focus more on defining our brands and enhancing the attractiveness of our brands by improving our products.
I was going to say, are you seeing a change in consumer demand because of those price increases, or do you think you can go ahead and do more?
Well, I think there are a bit too polarization. Some consumers, they are now going toward more a bit attractive price products like private brands. But actually, on the other hand, there are the consumers who can afford or who want to pay more even after the price hike, to the brand they believe in.
And I guess when it comes to Suntory, you have really a view of the entire globe, right? I mean, you're selling across regions.
Yes.
Are you seeing a divergence in the way that people consume your products?
Well, no, we don't really see a big movement, big shift. But some part, yeah, we have already just noticed some shift to the more private, with a lower price private brands.
So when it comes to the weaker yen, how does that affect your company where you're exposed to different regions?
Well, the weaker yen, we have the impact. One is a positive because we have expanded our business internationally. So on the consolidated basis, the sales and profit coming from international markets, we have a positive impact on the weaker yen. But on the other hand, if we look at Japanese market, Japanese consumers, well, the price hike of all the FMCG side, so that is a bit negative impact. And also for our business, we import some raw materials and packaging from the other parts of the world. So that gives us a bit negative impact on the cost wise, of course.
What sort of strategy for growth are you focusing on right now? Is it sort of more organic growth, or is M&A and deals sort of always in the pipeline as well? And if so, which sort of geographies or parts of the business would be priorities?
Of course, the organic growth is a very highest priority for our business growth. And we have already expanded our business in 88 countries in the world. And then our employers is 23,000 people. So again, the international growth is a growth driver. International business is a growth driver. But at the same time, our Japanese business is like a mothership, contributing to international business by the expertise in R&D, marketing, monozukuri manufacturing. So I think we can grow our business in collaboration with Japanese business, international business, in the organic level. But as you said, in organic level, we need to seek the new opportunity of the business growth. So through M&A or partnering. So we are always watching some space for this, inorganic business opportunities.
And for those deals, are they sort of more domestic opportunities? Are you looking more regionally? And which sort of product mix do you think would benefit most from that?
Well, we don't have a specific region to do investment. Of course, we are watching quite globally and widely any regions, any business country. But at the same time, in terms of the category, of course, now we have seen the global consumers trend is moving up to more healthy side, well-being side. So that will be a potential area for us to watch.
There's a lot of optimism about the market in India. I do wonder, though, with the cheaper yen, is it more difficult right now to do these M&As, especially given that you drove a lot of these M&As back before you took the helm at Suntory Food and Beverage? Is it more difficult now?
Well, compared with the several years ago, of course, it's a much bigger, huge amount for us. But of course, we shouldn't lose the opportunity of getting some good new, business opportunities. So, of course, the weaker yen might be something to reflect, but more importantly, we find something good to invest.
And did you find something in India?
Not yet. For India-wise, our sister company, Spirits Business, they have already do the business there. And for soft drink side, as our company, we're still watching the space there.
Now, you're the first female CEO of a listed Japanese company with a market cap of more than $1 trillion. This food and drinks and alcoholic beverages business is a very male-dominated business, isn't it? How big of a challenge is it to overcome as a Japanese female CEO, especially when it comes to bringing more talent down the pipeline?
Well, actually, yes. For the big or middle-sized, big-sized Japanese companies, we see very few female management, in especially top management as well. So I think it's a good timing for us to open the door for the female leaders, senior leaders, because they used to think there might be some ceiling there, but now I want to show them it's open now, so they can work much harder to get there. And Japanese companies itself, they need to change. They need more diversity to do the business globally. So I think Japanese companies, Japanese people, they are more lived in a bit homogeneous society. And I think the very important thing is we need to be more open to the other perspective, other culture, other values, including of the female. So diversity and inclusion should be very essential.
Makiko Ono, really great to have you here in our Tokyo studio, President and CEO of Suntory Beverage and Food. We have more ahead on the Asia trade. This is Bloomberg.
The history of technology seems to be that the big get bigger. But also, sometimes out of nowhere, a new company gets created, like Facebook or TikTok. And at the beginning of these new waves, the new winners, 10 or 20 years out, some of them are existing companies and some of them are new. But the new ones that get big, there's maybe one a year, no more.
Go-To Management founder and portfolio manager Philippe Lafond speaking at the Bloomberg Invest event in New York. And some of the other tech stories that we're tracking, Rivian shares jumped after the bell in New York as Volkswagen announced plans to invest $5 billion in a joint venture with the EV maker. The tie-up will give VW access to Rivian's technology for its cars. It's also a much-needed source of fresh capital for Rivian, which has struggled to ramp up production and deliveries. Chinese online retailer Meituan is said to be considering raising more than $1 billion through a bond offering this year. Sources say the proceeds will be used to repay some debt and fund overseas growth. Earlier this month, Meituan CEO said the firm was looking to expand beyond Greater China and into the Middle East. Paramount shares fell after the company revealed it's talking to potential international partners for its streaming TV business. Co-CEO Chris McCarthy told staff a deal could transform the online service and make it profitable. Earlier this month, Paramount's controlling shareholder Shery turned down a merger offer from Skydance Media. Take a look at how U.S. futures are trading after we saw that rebound in the overnight session, led by those magnificent 7 stocks and Nvidia, which came out of that correction territory. Still the most expensive stock in the S&P 500, up about 150% this year already. We're seeing NASDAQ 100 futures slightly in the positive, but really not doing much. Of course, we have seen a lot of volatility in U.S. stocks in the past week, and we are trying to digest U.S. consumer confidence continuing to weaken, not to mention Fed speak that we got overnight, including Lisa Cook saying that it will be appropriate to reduce rates at some point, adding that she expects inflation to improve gradually this year. We have more ahead on the Asia trade. This is Bloomberg.
I mean, if you look at the chart on Nvidia, you can barely see the correction. So, I mean, on a percentage basis, it's down something like 10%, but you have to peer really, really carefully at the chart to see that move. So, I don't think it means anything. The people who own that stock know it's expensive, but they're buying into a story. And as long as the story is intact, like Nvidia is obviously intact, the story is going to continue.
Bigger Bowman Group Steve Eisman there talking about Nvidia, of course, which had a bounce back after that $430 billion stock sell-off. Take a look at the state of play when it comes to, which is about 30 minutes into the start of cash trading across most Asian markets here. We're seeing the Nikkei really the standout here, with IT and tech stocks up by just about 1.5%, clearly benefiting from that bounce back for tech mega caps in the US session. We're seeing broader upside of just shy of 0.5% there, but the Kospi seeing a bit of weakness. Sydney stocks also looking weaker as we wait for that May CPI number. That's expected to have ticked up to 3.7%. Not typically the key quarterly numbers that we look at, but certainly important enough to potentially move the needle for the RBA and putting the risk of tightening back on the table as well. We did hear from the RBA Assistant Governor Chris Kent a little bit earlier talking about the restrictiveness of monetary conditions, but that perhaps some of the larger firms have not been as affected. But we are seeing that pressure, of course, being played out for households and smaller businesses in Australia. So a pretty fine balancing act then. But of course, front and centre is really what we're seeing across the tech space. And OpenAI is reportedly taking steps to block China's access to its AI tools. The move by the ChatGPT creator is set to be effective from July. Annabelle is in Hong Kong with the details. So, Belle, what's being restricted exactly? Why now?
Yeah, so Heidi, this relates to OpenAI's API, which is essentially how developers gain access to models like ChatGPT, for instance, and then they integrate them into their own software or platforms or applications. So what's happening now is exactly as you said, Chinese developers are going to be cut off. And it's, of course, interesting to note because OpenAI is actually officially unavailable in China, but we know that a number of developers there have been accessing it through virtual private networks or VPNs. So essentially this story, it first developed in local media, and we had the likes of the Securities Times, for instance, picking up these screenshots that were sharing these details. As that went on for a few hours, but then we later got confirmation from OpenAI itself saying that essentially they would be taking these steps, as we said, to block API traffic from regions where it doesn't support access to its services. That was a quote there that came from an OpenAI spokeswoman. To the other part of your question, what exactly prompted this, that is a little bit more unclear. So we know that, for instance, just as recently as a few weeks ago, OpenAI was shutting down so-called influence operations in places like China because there was concern that there would be campaigns, of course, to spread disinformation, misinformation, and this is a really pivotal election year. So we know that there's focus on OpenAI and it's under pressure for that. But the bigger theme sort of that overarches this is really that geopolitical tensions and the influence or the pressure that we're seeing from Washington on companies to restrict China's access to AI technology. Of course, unclear exactly what prompted it in this specific case.
But have we seen any kind of reaction from Beijing?
No reaction from Beijing, which perhaps you might expect, as I said, given that OpenAI is officially unavailable in the country. But some of the more interesting reaction has been from China's private sector. We know that there is just so much intense competition, and we've spoken with the likes of Kai-Fu Lee, for instance, from Sinovation Ventures, who says that China is yet to have its own ChatGPT moment, but there is a lot of pressure and competition within Chinese tech giants to achieve that. Off the back of that move, we've actually seen the likes of Alibaba, for instance, or Jipu AI. This is a Tencent-backed company saying, developers, you know, if you've been cut off, incentives now, come over, come and use our own platforms instead. So that was sort of the reaction that came from the private sector. For Chinese tech companies, perhaps this is a net positive, given you're taking that international competition further out of the space. And again, it sort of plays into Beijing's ambitions as well, because we've got that third-party plenum coming up. China is likely to emphasize that need to achieve self-sufficiency in tech, and that as well, Shery, includes AI tools.
Our tech reporter Annabelle Drewler's there. As we continue to watch those semiconductors in the trading session here in Tokyo and South Korea, of course, we have seen Nvidia rebound after that $400 billion market cap wipeout that we saw in the volatility in the U.S. markets. Take a look at how they're trading at the moment, because we're seeing a little bit of a mixed picture with Samsung falling 0.3%. But of course, overnight, the story was again of exuberance around artificial intelligence, around the Magnificent Seven, and around Nvidia, which has now come out of correction territory, but still the most expensive stock in the S&P 500, up more than 150% this year. Advantest also gaining about 5%, gaining for a third consecutive session and at the highest level since April of this year. Let's talk about its business and the business of semiconductor testing devices, which is set to play a key role in the AI boom. Advantest has just delivered a medium-term plan targeting an average operating profit margin of up to 28% through fiscal 2026. Let's discuss their business outlook with CEO Douglas Lefever. Douglas, great to have you here in the Tokyo studio.
Thank you for having me.
Let's talk a little bit about your plans and how much of the AI boom and demand you're factoring in this medium-term plan.
Oh, certainly. I mean, it's no secret that AI is driving so much of the industry, and we're part of that as a capital equipment supplier into semi, particularly in the test solutions area. So AI, just by its nature, is very complex devices, and complexity typically means a lot more test content to ensure yields and reliability.
And HBM, high bandwidth memory, making up more than 50% of your memory testing business. Do you expect that share to grow?
We expect that to stay relatively similar, if not higher. There's a lot of other content that is related to high-speed DRAM devices as well that is associated with kind of data center build-outs right now. But certainly HBM is the hot topic right now.
When you're looking at the outlook for the broader chip sector, what's the difference between what you're seeing short-term and long-term? Are you seeing the demand short-term as you're expecting to see given the AI boom in the longer run?
Yeah, I think it's a very interesting question and very relevant. Certainly, the data infrastructure build-out with AI is upon us, and that's still in the beginning stages, I would say. But what's coming closely behind it now is the use of AI in edge devices. And so mobility and other consumer electronics, we are seeing now that pick up. And typically that will have a very, very long lifespan as these computational architectures are upgraded.
We talked a little bit about those upgrades. Douglas, what do you see as the spend forecast, right? Is there a risk that a lot of these cutting-edge products are going to be prohibitively expensive, and does that then correlate to perhaps a slowdown of output?
I don't really think so. I think that the efficiency gains that are being brought forth by some of these complex devices and with AI and high-performance compute, they're priced at a point that is creating value for their users and for the industry, and so we don't see that stopping.
So do you see the trend of ever-shrinking transistors as one that just continues as the AI boom continues to demand that?
Certainly when it comes to process nodes, there will be a continuation of Moore's Law, though it's slowing. And I think what's important for everybody to understand is that it's not just Moore's Law. Now the industry has figured out how to do what's called 3D packaging. So the devices can go into the vertical space, and they can include many, many different chiplets or dielets in a package that then is something with higher content and higher value.
How much of a risk or opportunity do you see geopolitical tensions and the sort of bifurcation between major powers in this space?
That's existed for a while. Certainly, the decoupling is upon us, and we're not immune to that. I mean, we're in the ecosystem, we're in the value chain. We test semiconductors that first start as wafers, and so the restrictions placed upon the wafer and the tensions between the U.S. and China do have an effect. I would just add, though, that beyond that, there's other kinds of complexities in the world that aren't just geopolitical. They're access to human capital and resources, power, water. Those types of things are creating a lot of changes and a lot of complexities in the system right now, above and beyond what we would see just with what now standard geopolitical risks.
So how do you hedge for all of those risks?
We're been around for 70 years as a company. I want to say we're celebrating our 70th anniversary this year. So Advantest, we've seen lots of different ups and downs. So I wouldn't categorize it mostly as risk, is more as our long-term belief in semiconductors. So it's a cyclical business. It always has been, but it's been a cyclically up business. And so we typically will invest right through these cycles. And sure, we take short-term, hedging things with foreign exchange and other things like, as a responsible company should do. But in the long term, we usually make a long-term plan and invest into that next cycle.
Because it's so difficult to really foresee demand when it comes to this sector, isn't it?
Yes.
How do you really future-proof your business in that sense? You were mentioning edge AI, for example, in local devices, and we've seen that, for example, handsets and the smartphone market has stalled for quite a while. Will there be renewed demand to come because of these new technologies?
Yes. Yeah, we think so. And the strategy the company has taken is what we call platform strategy. And so we'll invest in instruments and technologies that have longevity in them. So we'll design instruments and power supplies and digital pins that can cross over generation to generation and from market segment to market segment. And so typically, while we're a technology company, in some ways you can look at us as an industrial company, as a hybrid company that way. So we typically get a good efficiency out of our R&D, and that can stand the test of some of these, shorter term volatilities.
I know that in your midterm plan, you were also prioritizing investments in, as you mentioned, R&D, but also M&As. Given the cheaper Japanese yen, does that factor into some of those calculations when overseas investments become more expensive?
It can. It wouldn't be the deciding factor at all. So we always look at the companies that we acquire carefully on the value that they bring to us and to our customers. If they happen to be in a region that's advantageous with the currency, then certainly that helps. But that's down the list. Number one is always culture, and then innovation, and so usually the currency level is a factor. But since we're a long-term company, we don't typically factor in the currency so much in our
Are you seeing
decisions.
some of those opportunities around culture and innovation, and where?
Yeah, definitely. We have a unique culture in Advantest that we're very proud of. We were born in Japan back in 1954. Takeda Regan was the original company name. And so we've worked hard to develop that culture and then push it from Japan outside of Japan. We're operating now in, I think, 18 different countries, and more than half of them.
Do you see a good fit to come?
Yeah, we do. We see good fits out there, and mostly for the needs that our customers are bringing. These complex devices require really, really innovative solutions, and so that's a big part of our solution set.
Douglas Lefever, good to have you with us here in the Tokyo studio. He's the CEO of Advantest, and of course, if you missed any part of this conversation, TV Go is your function. You can also dive into any of the securities or Bloomberg functions that we've been talking about and become part of the conversation. Do send us instant messages. This is for Bloomberg subscribers only. Check it out at TV Go. This is Bloomberg.
An anti-green backlash in this year's global elections supercycle is already taking a toll on ESG assets, with the ultimate test still to come in the US presidential vote. Our Asia Stocks reporter Ishika Mukherjee joins us now. So, of course, an unprecedented year for global elections. We're seeing a lot of volatility around climate-related policies. What are we seeing in the investment space?
Hey, Heidi. We're seeing the impact in major markets such as India, South Korea, or even Europe, Europe being the biggest one so far. A renewables gauge, for example, in Europe fell more than 4% in the immediate aftermath of the European Union elections, which saw the far-right groups actually capture most seats. So they now have a quarter of seats versus a fifth in the previous government. And the European Greens, who back climate-friendly policies, lost seats. And that's leading to a lot of investors sort of shifting around their portfolios. They're not looking at renewable energy projects as much. Aberdeen, for example, has trimmed its exposure to renewable project developers. And you're seeing even a green bond sale by SFIL, which is a French development bank. They've pulled that green bond sale ahead of the French elections on June 30th because of all the uncertainty around the far right and what fiscal policies they could bring and what environmental regulations they could pull back on. Here in Asia, in India and Korea, you also saw renewable stocks getting sold off immediately after the election. But in India, policy certainty has come back, so you've seen them climb back again.
Of course, we have big elections in the U.S. as well, and a potential Trump presidency again. How are investors preparing for that?
Yeah, what's interesting is that no one's expecting a total halt to Biden's Inflation Reduction Act, really, because that's helped a lot of Republican states. So it's going to be tough for Trump to roll that back completely. What we do have is estimates, such as from Bloomberg Intelligence, saying that about $369 billion worth of grants, loans, and tax incentives are at risk if Trump becomes president. And that, of course, will affect sectors such as electric vehicles, again, renewable project developers. So you're seeing PICTE trim exposure to these areas. BNP Paribas is investing in the U.S., but it's also in wait-and-see mode, not just there, but in Europe as well. The worry is also just coming at a time interest rates are higher for longer. So the more uncertainty we have around rates and politics heading to the November polls, you're going to see more investors pull money out. You've already seen big liquidations for ESG ETFs. And the worst ever outflows from U.S. ESG funds in the first quarter of this year. And it doesn't look like things are going to look any better up until we have political certainty come back.
Our Asia stocks reporter Ishika Mukherjee there. Take a look at the broader Asia market trading session right now because stocks are turning more positive as the hour goes by. We had the Kospi in negative territory at the open. It's now turned positive, up 0.2%, being led higher by, not surprisingly, information tech, also consumer discretionary stocks and energy stocks as well. Of course, we had the rally in the Magnificent Seven in the overnight session on Wall Street, and the Nikkei is also up 0.5%. We continue to watch the Japanese yen in very narrow trading, a little bit of weakness again after some strength in the overnight session given dollar selling by companies near quarter end. But one stock that we're following very closely is Chiyoda, shares sliding the most in about a month. This is a Japanese engineering contractor that has said that it expects full-year operating losses of 15 billion yen because of issues related to a LNG project in the U.S. So right now, shares are down 1.3%. And we're also following the latest on Chinese developer Shimao. It's set to defend itself against the creditor's demand for liquidation in a Hong Kong court today. A key moment in its years-long debt struggles. Bond and loan reporter Loretta Chen joins us now. And Loretta, this is a really interesting story because this is supposed to be a state-backed bank that's now facing these issues.
Yeah, that's right. So China Construction Bank Asia first filed these winding up petition in the Hong Kong court in April. So this is the first time that Shimao will be in the court to try to defend itself against that petition. So China Construction Bank said, this is related to some borrowings of loans. At the same time, Shimao in the past couple months has constantly faced a lot of counterings from its bondholders regarding its restructuring plan. So from what we know and other media reports, we have seen at least two sort of rejections from the bondholder side about Shimao's latest restructuring plan. And the latest we're hearing from sources is that it seems like there is new attempt to try to sweeten those restructuring terms for Shimao ahead of its winding up hearing.
And we heard earlier this week that Kaiser has been given 7 weeks to work on its debt restructuring. Will the court want to see evidence of debt negotiations, and has progress been made for Shimao on that front?
Yeah, for Shimao, I think today it's its first ever hearing. So in a sense, it still has some leeway to try to persuade the court that the progress is still ongoing. At the same time, you know, it's a defaulter since 2 years ago. So it's been a long time since the company's been trying to work on that restructuring plan. So I think in today's court hearing, the most likely scenario will be that Shimao would present, you know, these are the initial terms that it has presented around 6 months ago to its creditors, and it has to show, you know, what kind of progress it has made in those negotiations with creditors. But we're not expecting any surprises in today's court hearing. We think that Shimao will likely be given more time to work on that agreement with creditors.
Our bond and loan reporter Loretta Chen. There are just a number of hearings that we're watching this week in Hong Kong. Be sure to tune into Bloomberg Radio 2 to hear more from the day's big newsmakers. You can get in-depth analysis from the Daybreak team. We're broadcasting live from our studio there in Hong Kong. You can listen in via the app, that's Radio Plus, or BloombergRadio.com. Plenty more ahead. This is Bloomberg.
A lot of movement in the future session after we saw that rebound in the overnight Wall Street session, with the Magnificent Seven again leading that rally. When it comes to TAIEX futures, up 0.4%, but the FTSE A50 China futures closed down 0.25%. Of course, in China, we continue to watch the summer Davos in Dalian, with Chinese Premier Li Qiang warning of negative consequences for the world if nations part ways economically. Haidi, really a lot of attention right now on those trade tensions continuing to simmer between the West and China.
Yeah, and it's really hard to see that improving as we get into, you know, really key parts of this election supercycle by going into November with the US presidential election. But take a look at how currencies are faring at the moment, Shery. Of course, we're always on dollar yen watch, and Citi is saying that they see almost unlimited possibility for yen intervention. It's been holding pretty steady at just shy of that 160 handle. But Citi is saying that intervention depends on two variables, the speed of depreciation and the absolute level. We're also watching dollar China there as well when it comes to that fixing, with the PBOC potentially looking to narrow that fixing spot gap. This is Bloomberg.